This week I'd like to talk about the Lifetime Allowance, which is another allowance introduced by the Labour government back in April 2006, which was A Day. In other words, it was pension simplification, which I mentioned in my last video when we were discussing the annual allowance tax trap. Well, that restriction, that allowance, restricts the amount you can pay in to pensions, which was always the way up until April 2006. All you had up until that date was a limit on how much you could pay into a pension and a benefits calculation. But from A Day, pension simplification, we then had a cap on how much you could have in your pension as well before you face a further tax charge, and that was known as the Lifetime Allowance. Now, when it was first introduced, it was quite generous. It was 1.5 million, and it did rapidly increase to 1.8 million, which at the time, April 2006, was still quite a high limit, so it didn't catch that many people. It was introduced by the Labour government to attack so-called fat cat bankers who received these huge bonuses that could go into their pension schemes. So they brought this in to restrict the ability to do that for these bankers of big PLCs. The trouble is, subsequent Tory governments reduced the allowance each year, and gradually it went down from 1.8 million all the way down to 1 million. And now, because it's 14 years later, 1 million is almost half of the original maximum limit, and it affects very ordinary folk now, not fat cat bankers, very ordinary people. So the government 3 years ago decided to start introducing indexation to this lifetime allowance. So it's gradually increased, and now it's a very weird figure, £1,073,100. I mean, you couldn't make it up. There's been a proposal to round this to nearest £5,000 to make it easier to calculate, but for some mysterious reason the government has refused to do that. Probably because they were expected to round it up by 5,000 rather than round it down by 5,000. Anyway, that's the way it is at the moment. Now, how does this allowance affect you? Well, you are allowed to have more than £1,073,100 in a pension scheme. The problem is, once you get above that limit, you do face a tax charge. Now, some people think you face the tax charge as soon as you exceed the limit. That's not the case. It's only when you draw benefits out of these pensions, or if you get to age 75, or if you die before that, that you face what's known as a benefit crystallisation event. This, in other words, when you draw benefits out of your pension, that's when you trigger a tax charge normally. Unfortunately, there are 13 benefit crystallisation events, which I think is completely over the top. And it means there's lots of tax traps for the unwary. So what I thought I would do today, just as an example, is use a client example. Let's call him Richard. The figures aren't quite the same as his own scenario, but it serves as good purpose to explain how this all works. Now, Richard has got a pension's combined value of 1.45 million, of which 950 million is in 3 final salary pension schemes, and the rest, £500,000, is in 3 money purchase pension schemes. Now, Richard's wondering which pensions to take first. He's age 64, he's married, he's got 4 adult children, he's got a year till retirement. He's persuaded to take the 3 final salary pensions first, and the combined value of those pensions, let me remind you, is £950,000. Now, what is the lifetime allowance limit? As I mentioned to you earlier, £1,073,100. So, if he takes his pensions at age 65, the £950,000 doesn't trigger the lifetime allowance because he hasn't yet hit that limit. So it's not the fact that he's got combined pensions of 1.45 million that exceed this limit. It's the fact that he hasn't drawn benefits, he hasn't triggered a benefit crystallisation event by drawing the first 3 final salary pensions before he hits this cap. So this is what Richard's decided to do. He is likely to take his money purchase pensions later, if at all. He may decide to just defer them forever, not draw them before he dies. Now, you might be sitting there thinking, maybe that's the way to avoid the lifetime allowance. You die, you don't have to pay it. I'm afraid the government's not that generous. If you die before 75, the tax charge is still payable, and it's on the excess, the 1.45 million minus the lifetime allowance, the 1,073,100. And the tax charge can be either at 55% if it's drawn as a lump sum, or 25% additional tax on the income from the pension on which you're already paying tax. So as you can see, these tax charges are not insubstantial. So Richard has decided to not take the money purchase pensions yet. He may never take them, but he won't avoid this tax charge. So what we've decided to do was to see if he could take advantage of this transitional relief known as individual protection 2016, under which you can get an increased allowance from 1 million to 1.25 million as long as the value of all of your pensions as at 5th of April 2016 exceeds £1 million. Are you with me so far? Okay, well, we did a valuation of all of his pensions for lifetime allowance purposes, and unfortunately the total value came to £950,000 rather than the limit of 1 million. So unfortunately Richard doesn't qualify for this extra lifetime allowance, which would have boosted it from 1,073,100 to 1.25 million. So it was a pity, but hey, that's the way life goes. But you may be in a position where you can exploit such a rule. This election needs to be made to HMRC. There's no time limit on it at the moment, but you may have trouble getting final salary pension schemes giving you the data as at 5th of April 2016, because they were only required by the government to provide the data compulsorily until 5th of April 2020. So what can you do about this? Well, the good news is we offer lifetime cash flow planning service known as Money Forecast, and within that cash flow service we can incorporate lifetime allowances and annual allowances, so we can help you plan and minimise the hit from these very unfair, high, unexpected tax charges. So if you are in this position where you've got a very high value pension and or you're paying high contributions, you know where to come. You know it makes sense.